Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who have subscribed to the channel. I really do appreciate it. The channel continues to grow because of people like you. On this channel, we cover dividend growth investing, dividend stock pick of the day series, Monday through Thursday, a stocks to buy for the next month coming up. That's what this video here is, as well as a portfolio update every Sunday. And then from time to time, I'll put out a informational video about a stock or about a stock topic, dividend topic, investing topic, around the dividend investing community. So if you are interested in that type of content, go ahead and join us on this journey to financial freedom. Join the Vested Interest community. Go ahead and hit that subscribe button down below and hit that notification bell so you're notified whenever we post any new content. And if at any time you like this video, go ahead and hit that thumbs up as well. It really does help a small YouTube channel like mine grow whenever you do all of those things to help with the YouTube algorithm, as well as drop a comment. Let me know what you think of the video at the end. So today we are going to take a look at 5 stocks, and if you stay to the end, we're going to take a look at one ETF. For those of you who may not be into picking individual stocks, maybe ETFs are more your flavor. So we will take a look at one that I just added to my daughter's custodial account here whenever it took a little dip down. So we'll talk about that one as well. And we are going to cover the 5 individual stocks: Dividend Energy, CVS, Williams-Sonoma, Pfizer, and Paramount. So let's jump right in the video. We'll start with what am I looking for my investing criteria, right? So I want to understand the business. I want the company to have growing free cash flow over the last 5 years and expected growing free cash flow in the future. I want a growing dividend payout ratio of 75% or less. It does not apply to REITs or BDCs. Typically, they have to pay out 90% or more based on the laws that they have to follow. And then I look at the valuation based on dividend yield theory. We'll see that here in a minute. I like to buy a stock whenever it is below my cost basis or within 15% of a 52-week low, no higher than that typically. The ROIC and ROE, return on invested capital, and return on equity equal to or greater than the industry average, or 10% or higher. And another one I kick in for a financial company like a bank, right? For financial companies, add valuation based on price to book. So price to book, and you're looking for something 1 or lower, right? And depending on the company, if it's near 1, maybe if you're looking at something like a 1.1, 1.2, it might be worth jumping into, especially if you're going to continue to build out the position and maybe bring down that cost basis as it's coming down, right? And it must meet 4 of 7 if it's not a financial company. If it is a financial company, it must meet 5 of 8 for me to even consider adding it to the portfolio. Obviously, the more the better, but that is my investing criteria. You should be picking your own criteria. Do not just blindly copy someone off a YouTube channel, right? Make sure you're doing your own investigation into these stocks. That's why I call this vested interest. It is in your vested interest to do your own research and do your own investing, right? So let's jump into the video and see what 5 stocks and 1 ETF that may be a potential add for the month of May. First up on the list is Pfizer, ticker PFE. This is out of the healthcare sector, right? You're probably aware of Pfizer. They basically are a biopharmaceutical company that sell pharmaceutical drugs. You can see here 52-week range as low as $38.31, as high as $54.93. So right up against its 52-week low. And in full disclosure, if you watch the portfolio update for Sunday, you will see that I just added this back into my portfolio as a new position. I actually had it at one time, sold it whenever it ran up into the low 50s. And then now that it has really pulled back, I'm looking to jump back into it again. So again, this is one that is in my portfolio, the only one of the 5 that is in my portfolio. You'll see that down here. I have 14 shares. My cost basis is $38.74. I am currently up slightly on the position, even though I just bought it, right? $542 into the position. Back to Pfizer up top. Market cap of $219.511 billion, and all of these numbers are as of Friday at the close of business. A beta of 0.59, so it is less volatile than the overall market. That is nice to see. That's what beta means. So 1 is the market. Anything less than 1 is less volatile. Anything over 1 is more volatile. Very low PE ratio on this one right now, 7.11, $7.11 here, price to earnings. Earnings per share, EPS, is very nice, sitting at $5.47. Next earnings date, somewhere in May 2nd, looks like. And for a dividend of $1.64, they are a quarterly payer with a very nice dividend yield, 4.22%. ex-dividend date coming up May 11th. So if you bought them the day before the ex-dividend date, you would be in line for the next dividend. And according to Yahoo Finance, where I pulled this information, $49.49 target for the stock price over the next year. Now, Yahoo Finance says it's near fair value. Looks like they estimate about a 1% return, so that would be right at fair value, really. And they say it has a bullish pattern. This is more for day traders or traders to look at this, but I wanted to be able to explain the information. And they see it short-term pullback over the next 2 weeks to 6 weeks. Midterm, same thing, 6 weeks to 9 or 9 million. So again, might be one to add to the watch list or potentially start a position. And if it does continue to pull back, you can continue to dollar cost average down and bring that cost average down. Now here we'll go over to what I like to look at for dividend yield theory. Look at the 5-year average dividend yield, and you compare it to the current, right, 4.22%, or the forward is what they call that. That's forward looking, 4.22% currently. And if it is higher, which it is currently higher, that speaks to some potential undervaluation. If this number was lower than the 5-year average, that would speak to some overvaluation based on dividend yield theory. Another thing I like to look at here, very low payout ratio on this one, 29.25%. So they have a lot of room to continue to grow this payout over time. Now we'll jump down and look at the financial efficiency of the company itself. And this is basically how they do with the money they are reinvesting or utilizing in the company, whether it's buying back stock, whether it's research and development, whether it's paying out dividends, right? Or they may be acquisitions, buying out another company. But it tells you how efficiently they are with the capital they are investing in themselves. And return on equity is at 35.1%, and return on invested capital sitting at 33.80%. So definitely higher than the 10% that we look for these two metrics. Another one I like to look at is free cash flow. Right, you want growing free cash flow over time because that is what the dividend is paid out of, right? So if you want a growing dividend, you also want growing free cash flow. So in 2019, they were sitting at 9.9 million. 2020, 11.6. 2021, 29.8. Little bit of a drop off here from 21 to 22, 26.03 million. And looks like to date right now they're sitting at 26 points. So that's the most recent numbers there. So this from 2019 to 2022, you definitely see growing free cash flow. You might want to watch this one a little bit, but that is almost to be expected. The CVD19 issue we had, big bump up here in 2021, probably still getting a little bit of revenue from that in 2022. You may even see a further drop off as that kind of levels out from 2023. So again, maybe one to watch a little bit, but definitely growing free cash flow over the last 4 years overall. And we already looked at my position down here. So that is number 1, Pfizer, ticker PFE, out of the healthcare sector. Next up on the list, we're going to look at CVS Health Corporation, ticker CVS. And this is out of the healthcare sector as well, even though they are a retail store, right? They sell a lot of the drugs that like a Pfizer would sell. They have their own brands, and then they do have a small market inside their store. This may be one that you guys use or shop at. I know I do. My kids love to go in there and look at the little toys and trinkets they have, or grab a pop or something. It's around the corner. We like to take a bike ride every now and again, and they love to stop in there. Right, $73.31 per share. Again, all these numbers are at the close of business on Friday. 52-week range as low as $71.94, as high as $107.26. So again, another one right up against its 52-week low there. They have a fair value estimate, a -4. So they see it a little slightly overvalued here. Again, take that with a grain of salt. Do your own due diligence on these. Market cap of $93.82 billion. A beta, another one less volatile than the overall market, 0.6 compared to the market. PE ratio is elevated, $23.27 price to earnings on this one. So this is a little higher than I typically like, but I may be willing to live with that if it looks like everything else is in line. Earnings per share, EPS, is $3.15. Next earnings date coming up May 3rd, right? So that one's going to be coming up here next week, along with what we saw for Pfizer. So another one to watch, the earnings date coming up. Forward dividend is $2.42. They are a quarterly payer, so divide by 4. Nice dividend yield, again, 3.31%. And the ex-dividend date has passed, so you would not be in line for the next dividend payout on this one. And they have a 1-year target estimate of $108.64, so it does speak to some potential upside appreciation. This one, they say it has a bullish pattern detected, but over the next 2 to 6 weeks, maybe a downturn. midterm 6 to 9 weeks, maybe up a little bit, and then long term down. Again, these are all more for traders, so take these with a grain of salt as well. Now let's jump over and look at dividend yield theory and the payout ratio. First, we'll look at dividend yield theory. 5-year average 2.79, and again, we are looking for their current forward annual dividend yield or their current 3.31. They're the same. We want this number above their 5-year average, and that's what we are seeing here. So this one again speaks to some potential undervaluation according to dividend yield theory. Payout ratio 70.06. Again, I like 75% or below, so this one does meet the criteria, although it is creeping up there a little bit. Usually, though, for retail companies, these are slow growers, right? So I'm not as concerned with this one. If this was a faster growing stock, then I might be, or faster growing payout, I might be a little concerned because that means the payout would probably slow over time. But typically retail stores are on the lower end of the spectrum for growth. So this one not as concerning. It is under the ratio that I like of 75%. Now down to financial efficiency, right? Again, want to compare it to the industry average. Again, for retail stores, they do not have a great return on equity or return on invested capital typically because they are cash intensive, right? They have a lot of locations they have to upkeep in, right? Maintenance of stores, rents, that sort of thing, unless they own their own. These ones do not. But very nice compared to the sector average, pretty decent. Return on equity is 5.7%. Return on invested capital 6.8%. And again, free cash flow, you want growing free cash flow over time so it covers the dividend. 2019, we were at 10.3 million. 2020, 13.4. 2021, 15.7. Another one that dropped down a bit here in 2022, right? You see that drop off, but again, should be expected. We have a bit of a pullback, recessionary. I think we've been in a recession for a while now, so anytime you have a pullback like that, you should expect a little slowdown. But overall, from 2019 to 2022, we are up in free cash flow, so that's what you're looking for overall, but is worth watching. If you saw this continually trend into 2023, it might be a little concerning. All right, CVS, that's number 2 on our list. Number 3, we're going to take a look at Devon Energy Corporation, ticker DVN, and they are out of the energy sector. Closed out the day at Friday, $53.43. 52-week range as low as $44.03, as high as $79.40. So they are, I would say, maybe mid-range, little closer to their 52-week low than their 52-week high, but not up against it like the first two that we saw. They do have a fair value estimate, a 3% return here, so it looks like it might be a little undervalued based on what Yahoo Finance is saying. Market cap of $34.943 billion, a beta of 2.36. Now this one is way more volatile than the overall market. That is extreme volatility, over twice as volatile, right? So you want to be aware of this particular company. A lot of volatility here. If you were interested in this because it is so volatile, I would try to pick it up closer to this 52-week low here, right? That's just my opinion. Price to earnings, PE ratio is $5.86. That's decent. That's actually pretty low. Earnings per share, EPS, sitting at $9.12 per share. Next earnings date is coming up, again, May 8th. So right in the beginning, a lot of these earnings dates are coming up here. So if you are interested or are in any of these companies currently, you want to be watching their earnings date coming up. Forward dividend is $5.06 paid out on the year, and a very nice dividend yield, 9.51%. Though this one pays out dividends kind of sporadically. They are not necessarily a quarterly payer. They do kind of follow a quarterly pattern, but they have a lot of special dividends along the way. They do return a lot of capital to the investors, right? So you might get a dividend payout in the beginning of March, for example, and then get another one right at the end of March. So they do pay out kind of sporadically, but they do return a lot to investors. So that's nice to see. Ex-dividend date, last one was March 14th. And 1-year target, at least according to Yahoo Finance, is $66.37. So that speaks to some potential upside appreciation. Again, they have a bearish pattern on this one, so they see it coming down over the next 2 weeks to 9 months. So again, if you wanted this one, throw it on the watch list. I would try to find something closer to this 52-week low. And we'll jump over here to dividend yield theory again, 3.2% 5-year average, currently sitting at 9.51, so way higher than their 5-year average currently. So speaks to some potential undervaluation and serious undervaluation on this one if you just go by dividend yield theory, though this one is not one I would trust as much because of the way they pay out dividends, right? Payout ratio sitting at 56.69%, so plenty of room to continue to increase the dividends over time. Financial efficiency, right? Return on invested capital, 58.1%. That is massive. That is a huge return on invested capital. Same thing with return on equity. Same thing with return on invested capital, 34.7%. Very nice numbers to see here. Free cash flow, 130,000 in 2019. 2020 was 193,000. 2021, 2.8 million, and 2022, 3.4 million. Extremely fast growth free cash flow, which is probably why they pay out those sporadic special dividends over time, right? They are a lot of free cash flow and they're returning it back to the investors. This is one I really like, but I would definitely look for it closer to the 52-week low because of this high volatility here. All right, that's number 3, Devon Energy. Number 4, this is a Warren Buffett stock here. He's picked this up within the last couple of years. We are talking about Paramount Global, ticker PARA. They are out of the communications sector. They are a company, a streaming service. They do movies, that sort of thing, right? Entertainment company here. 52-week range as low as $15.29, as high as $34.50. This was actually kind of sitting at $23.33, sitting mid-range, right? So another one I would probably throw on the watch list if you were interested and see if we can get it back closer to this 52-week low. They have a estimate here of 20% return. So they see this as extremely undervalued right here. That may be what Buffett sees as well. He's a lot smarter than me. So I tend to look at his 13 Fs to kind of see what he's buying and selling over time. Not necessarily copy everything, but use it as a guide anyway. Market cap of 15.34 billion. Beta of 1.66, so another one that is more volatile than the overall market. So again, because of that volatility, you can kind of play that and try to get it closer to this 52-week low, as it should bounce up and down within a range. Typically, that's what they're seeing here with this volatility. PE ratio, another one I see is a little elevated, 22, price to earnings, $22.43. Earnings per share, EPS, sitting at $1.04. Earnings date, another one coming up here next week in May 4th. Forward dividend is 96 cents. On the year. They are quarterly payers, so divide by 4, and a very nice dividend yield, 4.16%. Ex-dividend date was March 17th, and a one-year target, at least according to Yahoo Finance, is $20.86. So again, because it is currently sitting above that, I would play this volatility if you are interested in this and try to get it back here at this 52-week low or close to it. And 5-year dividend yield theory here, let's go. 2.72 is the 5-year average, currently sitting at 4.16. So according to dividend yield theory, another one that is undervalued or potentially undervalued. Payout ratio is elevated on this one, 93.2%. So this actually is above my criteria. I like 75% or lower. A little concerning on this one because they don't have dividend growth from what I could see. So this one is more, again, more you'd really want to be in this company and maybe even one to play just to get it here at the cheaper and then ride it out to the highs and make some return on the stock price that way instead of riding it out long term for the dividend yield. But that's a little elevated. That's a little concerning to me, right? Return on equity and return on invested capital, 4.8% on return on equity, 5.4% return on invested capital. These are pretty much in line with what you see from similar companies, right? Again, very capital intensive, takes a lot of money to make movies, streaming services, right? They have a lot of competition. There are a lot of them out there, so there's not a big return on their equity or return on invested capital. Free cash flow, let's take a look at that real quick again. 2019, 877,000, 2020, 1.9, 2021, 599, and this is why right here you see this negative free cash flow, negative 139,000. That right there is probably why you're seeing such a high payout ratio, right? So that is concerning. So a couple things that are concerning on this one, even though it is one that Buffett bought, he may be looking at this as a turnaround play. 93.2% payout ratio, decreasing free cash flow. Two negatives on this one for sure, right? And the last one on our list, Williams-Sonoma, ticker WSM. This is a consumer discretionary company, $121.04 at the close of business on Friday. They have a 52-week range as low as $101.58, as high as $176.89. So it is closer to that 52-week low, though it is not right up against it. It's a little higher than the 15% typically that I like. You probably want this around the 115 range or lower if you wanted to get it within 15% of the 52-week low. They have an estimate fair value that it's currently 7% undervalued, right? That's what this 7% estimated return means, and a bullish pattern. So they see it may go up short term, but long term down. And typically, consumer discretionary companies do get hit hard in recessionary times. Market cap of 7.948 billion, beta of 1.6, so another one that is more volatile than the overall market. Low PE, price to earnings on this one is $7.42, so very low PE on this one. Earnings per share, EPS is very high, $16.39. That is very nice to see. Earnings date coming up in May 23rd through the 29th, sometime in there. Forward dividend is $3.60 paid out on the year. They are quarterly payers, divide by 4, and a nice dividend yield, 2.94%. Ex-dividend date was April 20th, so if you have not bought them yet, you would not be in line for the next dividend, and a one-year target estimate of $132.24, who speaks to some potential upside appreciation, at least according to Yahoo Finance. Bullish pattern, again, so they think it might run up over the next 2 to 6 or 9 months, and then 9 months longer, they see it coming down again. Consumer discretionary typically gets hit during recessionary times. Now, 5-year average dividend yield, we'll look at dividend yield theory again. It's their 5-year average sitting at 2.33, and the current 2.94%, or what they call forward, is 2.94. So it is higher, so it is potentially undervalued, though not a ton, right? But does speak to some potential undervaluation, and a very, very low payout ratio on this one, 19.12%. So a very long runway for them to continue to increase the dividend over time, pay down debt, make acquisitions, buy back shares if they want. They have a lot of room here in their free cash flow. And this is another one, very nice return on equity and return on invested capital. Return on equity, 79.1%. That is massive. Return on invested capital, 40.2%. Wow, that is amazing. Another one I really, really like, Williams-Sonoma. This definitely, it is on my watch list. All of these companies are actually on my watch list. I am looking for it closer to this 52-week low, and I actually am considering selling out of my Whirlpool position and rolling that into Williams-Sonoma. Now, free cash flow is the last one we want to look at on this one. 2020, 421,000. 2021, 1.1 million. 2022, 1.14, and they've already started reporting numbers in 2023, currently sitting at 698, though this is not complete. So I would just go from 2020 to 2022. You can see that free cash flow growth over time. One I didn't really point out on any of the other ones, you can see if they're repurchasing stock. Most of these companies are. That's a kind of a bonus one I like to throw in there. And basically what that's showing you is that as they repurchase stock, if you were to put $1,000 into this company and then never buy another share, as long as they continue to buy back shares, you would continue to increase your ownership, right? That's what that means. As they decrease the amount of stocks out there, your ownership of the company actually increases. This is probably my favorite out of the bunch besides Pfizer, which I just added to my portfolio this week. This one I really, really want to get back closer to this 52-week low. It's just a little over where I want it to be cost-wise, but it is one that once it gets there, I am going to be adding this to my portfolio. It does not mean you should. Just is one that I want to as well. So that is Williams-Sonoma, ticker WSM. Now, last up on our list, this one, like I said, I actually just recently added this to my girls' custodial account, both my daughters. And when I say add, I actually had it on a buy at a certain price. I had set it up for like $71.20. So it did dip down. It hit that for the day. It made that purchase, picked up 100 shares of this one for my daughters at $71. If it goes below that, I will probably add to the position even more. Really like this ETF, even though I don't have any ETFs in my portfolio. I'm actually a firm believer of you can look at like the top. Here's the top 15 holdings over here on the right. Like I own many of these. Verizon. I used to own Coca-Cola. I used to own Chevron, but I sold both of those because they ran up quite a bit. But I still own Verizon. I just added Pfizer. I own Cisco. All right, you could almost say, hey, the top 20 positions and make your own ETF on these. You can see the weightings. So what percentage of these companies are there, how many shares they own. So I wanted to give you a little bit of information on this. They do have 104 shares on this. They rebalance once a year. They are looking at dividend growth. And let's go through this real quick. They have a 52-week low of $65.96, a 52-week high of $79.49. So kind of floating in between the high and the low there. I was comfortable at $71 and some change, like I think it was $71.20 is where I picked this one up. I would be interested if it pulled back down. As it's going up, I won't add any more. But if it does pull back below their cost basis, I've got a little bit of cash in both of their savings account. Well, I'll probably add to this position here. This is a set it and forget it. Let them do the work. You do have a little bit of a expense ratio, so you want to be aware of that. If you are in ETFs, you want to get as low of expense ratio as you can. This is about as low as you can get. I've seen some down 0.03, but 0.06 is pretty low, and you don't get much lower than that. They have net assets of $46.54 billion. That's the amount of people who are invested in this total amount of the funds with people invested in it, right? PE ratio 13.77. I believe that's just the average of all the companies within it. Nice dividend yield here, 3.61%. A beta of 0.82, so it is less volatile than the overall market, right? Even though it is got 104 different positions within there. That's nice to see. Overall volatility less volatile than the overall market, so your drawdown should be lower if we have a decline there. 3.64% dividend yield, we see that above. They don't really match up, but this is from another site that I like. The ones you saw before were Yahoo Finance. Another one that I like is stockanalysis.com. So this information comes from stockanalysis.com. Dividend yield, $2.64. So this is not completely accurate either, because if you look down here, I pulled up that you can see the dividends pay out quarterly, but they are not always the same. Right? You had 70 cents and some fractions of a penny, 63 cents and some fractions of a penny, 70 cents again, fractions of a penny, 59 and some fractions of a penny. So they kind of bounce between, you could say, this 59 to 70 cents or even 58 cents to 71 cents right in there if you wanted to use those numbers. But it's not always the same payout ratio every time you get it. But their payout ratio is low, 54.24%, and they do have nice dividend growth, 16.63%. I'm not saying they're going to keep that up into the future forever, but that is very nice dividend growth over time. Ex-dividend date, the last one was March 22nd, so they should have one April, May, June, coming up in June, right? Well, that is it. Those are the 5 companies that I am watching for the month of May. Actually, Pfizer, I just added to my portfolio and will continue to add to that one so long as it stays close to its 52-week low or below my cost basis. I want to say around $41 or lower. I will continue to add to that position and build that one out. Let me know what you think of the video. Let me know what you think of the stocks that I've looked at or that I'm looking at for this month. This is an older picture here. I'll have to update this. We've actually got this dirt pile is gone. We've had the yard leveled out. The pool is open now, and they are going to be bringing in some more topsoil and sod here in the next couple of weeks. It's just been raining here at my house quite a bit. So I'm hopefully this week that we're going to get that done, and I can take some pictures of what it looks like with the pool open and the yard back to normal with grass on it. I know my dogs will like to be able to get back out there in the back, but that is an older picture from this winter. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Drop a comment down below. Let me know what you think. Let me know what you think of the 5 companies, right? We've got Pfizer, Williams-Sonoma, CVS, Devon Energy, and did I say Williams-Sonoma? Williams-Sonoma, CVS, Pfizer, Devon Energy, and Paramount Global was the 5th one, as well as SCHD, the one ETF. Are they in your portfolio? Are they companies that you are interested in buying? Or are they ones you're staying away from altogether? Do you have companies that you like better right now? Drop it all down in the comment section below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, suggestions for future topics, or constructive criticism. Go ahead and drop it all down there. Let me know what you think. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by. Hope you have a great weekend, and we'll see you in the next video. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk and abundance. Should never estimate any amount you're not comfortable losing. Always do your own research. Invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.